Hello, my friend. What's going on? This is Emmanuel Adekola, aka the Forex Apostle, coming to you from the Forex Apostle mentoring.com. So in this video, I'm going to be showing you how to turn every losing trade to a winning one. Okay, every losing trade, how to turn them to a winning one. In other words, how to hedge your trade, how to hedge your Forex trades for profit. That is what we are going to be looking into in this video. But do me a favor, okay? If you see any value in this video, smash that subscribe button, subscribe to this YouTube channel, share this video with your loved ones, like this video, and of course leave your comment at the comment section of this video. If there's any topic you want us to cover, do me a favor, leave it also at the comment section. I really appreciate your time and I don't take it for granted. So I'm going to give you 5 seconds and I will take you to the classroom section that I had with my VIP students. So I'm giving you free access to the training I have with them. Thank you so much, and let's get started. So let's just go straight to how to hedge the market. How to hedge the market. In other words, how to turn every losing trade to a winning one. Okay. So let's say, okay, you enter a trade. All of a sudden, the market turns against you. How do you take care of that? How do you turn that kind of a trade? How do you turn it to a winning trade? Or let's say, okay, you enter a trade, that trade is going in your direction before, and all of a sudden the market turns against you and you don't want to possibly cut off your loss. You know, there are different trading strategies. Some strategies use stop loss. If you use stop loss, then it therefore means that you've already decided before, and that is the normal thing to do anyway. That's the normal thing to do before you enter a trade, okay? But that is more of theory, especially in today's market. It's, for instance, if I trade somewhere like indices, I don't use a stop loss because it's a very volatile market, very volatile market. But in books and in theory, that is what you are expected to do. Okay, before you enter any trade, you should be able to determine how much you are willing to risk, and that is your stop loss. Okay, so that is your stop loss. We have discussed this extensively, that on every single trade you don't want to risk more than 2% of your account. I'm a kind of person that I don't use stop loss in most of my trading, and these prop firms, they are teaching me a lot of lessons in how to stick to that. Okay, so let's say, for instance, your account balance is $1,000. Of course, you don't want to be risking more than $20 of this account. That is 2%, if I'm correct. So that is 2%. And one of the reasons why many people lose their account or burn out their account is, in this $1,000 account, you will see people risking almost $800. Some will risk about even like $750. Imagine somebody that have an account of $1,000 and is trading Euro USD and putting one lot size, 1.0 lot size. If you are lucky and this trade goes in your favor, it will look as if you win jackpot, because before you know it, you just say, wow, you make maybe just 20 pips, and you have made $200. But what happens if this 20 pips is against you? It means that is minus $200 automatically. Or what if you are trading, you have an account of $1,000 and you are risking, you place a trade of 1.0 lot size, which is wrong. Okay, I don't care what kind of a lot time frame you are using. either it's a lower time frame or higher time frame, this 1.0 lot size, that is a lot for $1,000 account. But that is what some people do. So when they place that, if this trade goes in your favor, boom, you make maybe $500. You harvest 50 pips. Immediately, you will be so excited that, wow, this is cool. But what happens if this trade also go against you? That will be $1,000 minus $500 immediately. So you don't want to go into that. And we have discussed this before extensively, that if you have $1,000 account, what you want to be trading is like 0.1. That is even if you are trading on lower time frame. On lower time frame, 0.1, that is if you are trading regular currency pairs. If you are trading on higher time frame, then this 0.1 will even be for an account of like $10,000. So with this, you know that your mind is at rest. If you place a trade and you can't go to sleep, if you place a trade and you can't leave your desk, if you place a trade and you can't close your eye, if you place a trade and your blood pressure is rising, it therefore means that you have over leveraged that account. Okay, that is just by the way. So what we are discussing today is how to turn every losing trade to a winning one. That is how to hedge your trade. How to hedge your trade. How to hedge your trade. So hedging simply means that you are opening a reverse position to the initial position that you already have opened. So you go long, okay? Immediately the market starts going against you. Then what you do, if you did not use stop loss, is you can open a reverse position to that trade. Okay? Does that make sense to you guys now? So that is how what we call hedging. Some brokers allows it, some brokers they don't allow it. But when you are fortunate to be using brokers that allow it, then you are lucky. And we are going to be looking into taking some examples, and of course we will tidy it up. So let me share my screen. Let me share my screen with us. Once again, this is definition of hedging. Hedging in the forex market is the process of protecting a position in a current pair from the current risk of losses. That word is very, very important. This word, very, very important. That is the currency pairs that you are trading. So if you have a trade on €USD, if you have a trade on €USD, which is long position, okay, if you want to hedge this market, the same currency pair that you have going on is what you are focusing on. Not that maybe, okay, you have long position 0.1 on a €USD, then you now see another opportunity on GBP USD and you open that trade. That is no longer hedging. That is no longer hedging. When you are hedging, you focus on the initial pair that you are dealing with. Is this making sense? If this is making sense to you, type yes on the chat window. So you are dealing with that same currency pair. That same currency pair that you are dealing with is what you are going to open in a reverse direction. Now, there are two ways of hedging, okay? Two ways that I normally do. The first one is if you are entering a trade and you are not clear. You are not clear with, okay, the direction to go. So ordinarily, if I'm to trade a let's say if I'm to trade 0.5 lot size, okay, if I'm to trade 0.5 lot size, so initially I could just enter 0.1 for that trade. So if this 0.1 is going on against me, then I can now open 0.4 lot size, okay, in reverse direction. I can now open 0.4 in reverse direction. That is the first way. The first way you can hedge, you can turn a losing trade to a winning one. Now, the second strategy is, if let's say a market has been ranging and you don't know the direction it will go. Okay, a market has been ranging and you don't know the direction this market will go. So this is the high, this is the low. I use this with FX Sniper. If you have FX Sniper, especially on 1 hour time frame. Especially on 1 hour time frame, I use FX Sniper with this strategy. So what you can do is that you open 2 pending orders. So you open buy stop here. You open buy stop. Your stop loss will come below here. Then this place that it is your stop loss, that is where you open as a sell stop. Then this buy stop here will be your stop loss for the sell position. So you have 2 trades open. Okay, you have 2 trades open. So when I don't normally recommend it, but this is what some people do. I've done it 1 or 2 times and it worked best also for me. So when the market triggers, the first trade that triggers, then you close the second one. So let's say the market now break out upward. So you have your buy stop triggers, then you quickly close the short position. So let's say the market triggers and your sell stop triggers, then you close your buy stop. So that is another way of hedging the market, because number one, you are not sure of which direction the market is going to go, but immediately there's a breakout, then it can give you that insight of what to do. But of course, you know that there are some volatile market that will triggers your sell stop, come back to the buy stop, and cut off both of them and start going in another direction. Market happens, but it doesn't happen like that always. So I'm going to take us to, let's go to the chart and see. I hope we'll be able to pick some 1 or 2 trades and then demonstrate what we just discussed. If you have any question, you can go ahead and ask a question based on the strategy we are looking at. So this is a Dodge. This is Dodge USD. I picked Dodge because it's a weekend and I believe it's moving, it's trading. Let me see if Bitcoin also is moving. This is Ugo's way. So Ugo's way, I see BTC is not ticking, but Dogecoin is ticking. So now what I was explaining before is, let's say in this place you open a trade. So normally this is you open this trade. Let's say you want to be going short. Ordinarily you are supposed to have, let's say 0.5. I'm supposed to put 0.5 lot size on this trade. Then I can decide to put 0.1. So like this one now, this is going up. So I can do 0.1 and I'm going to just go ahead and do that. You can see 0.1, I'll go click on buy. So I buy now 0.1, that is expecting it to go up. Now, if you look at this is a margin that I'm using. This is a $90,000 account, and this is a live account actually. So this is what I'm talking about. If you have a trade like this, you number one, ordinarily you can leave this trade and just go to sleep. Okay, because no matter how this trade moves, you know that there's no way you can run down your account. I always focus on this my margin level. Ordinarily, most of the times, like for this margin level to be above 1,000%. But there are situations that can lower it to like maybe 500, 600, thereabout. Even I've had trades that it will be like a 300%, and that is on the extreme risky level actually. But on a normal level, I always want this my margin level to be like 1,000%. So you can imagine, okay, I put 0.1 for Dodge USD. This is 1 minute in order for us to be able to practicalize what we are talking about. So now I put in that 0.1 trade, and what I'm expecting is for the market to go up. So let's say this market now continue going downward. then what I will do instead of opening 0.1, because if you open 0.1, it will nullify this this initial 0.1 that you have. So if I have 0.1 short long position and the market keeps going down, okay, and I want to edge it, what I will do is I will open like 0.2 short. So by the time this 0.1, let's say it's like the 0.1 position is like a minus $10, you will discover that the one that you open as 0.2 might come up to be like a plus $20. So if you close the two trades at this time, then you can still go home haven with what? $10. So that is how I normally treat that, and that will be so. Like for instance, now you see this market is supposed to be going up now. All of a sudden we see it the way it's still coming down. I will not place a short position because number one, this is a 1 minute. This 1 minute, and then you can see this Bollinger Band. We are in a lower Bollinger Band here. This is upper one. So every time the market is below this lower band, okay, you can do your testing, back test. Anytime the market comes below this lower band, of course, it will always find its way either back to come and touch this lower Bollinger Band and continue again, or even most times just come back and go back up. It might come to the middle bar and start coming down, or break out from this middle bar and go to the upper one. This is the customized Bollinger Band, by the way. This is a customized one, and the regular Bollinger Band use 20, but this one uses 200. If you go to input, so the bands period, you can see I changed this to 200. Original default value is 20. If I change it to 20 now, this is what you will see. Okay, this is what you will see. This is the default value of Bollinger Band, but I don't like using this. So I like to use this to be 20, and what I normally just use it for is to target my entry breakout. Like for instance, if it comes like this, I know it will definitely go back up, as you can see. So because the goal is for it to come back up. If you see what happened to Euro USD, yes, Euro USD. Let me change to this. So like Euro USD, if you go back to, let's say, like 15 minutes, this strategy works both in the 4 hours, a daily, or whatever. So because like yesterday, when some people saw, okay, yeah, Euro USD is going down, it is when it gets to this place they start going short, and you can see what the market does, coming back right inside there. So you have to understand, anytime the market breaks out, okay, anytime it breaks out, I know this is different to the topic we are talking about, but it's by the side. Anytime it breaks out like this, that's what I use this for. I know one way or the other it will find its way back. It doesn't matter whether it's 4 hours, it doesn't matter whether it's daily, it will always come back like that. Okay, so like right now you can see we have $14. This is real money, this is live account, because I know it's going to come back to that point. But let's assume that it keeps going down. Okay, that is what we are talking about in edging. Then I will now open a reverse position and put it like maybe 0.3 or 0.4 in order for me to negate the zero that is there. So as you can see right here, you know, what actually happened was this is the first trade that I placed in that example on Saturday morning when we were having the class. And then when I noticed that, okay, the market was moving in my favor, as you can see the date, that was, you know, and I just, okay, you know what, I think I can add to this. So I added, you know, 0.2. In fact, got to a time I added 1.0 lot size to that Dogecoin USD trade. And then, of course, I ended up making $368.70 from that trade. So that is another part of hedging. You could add to your position, because as if the market moves in your direction, yes, of course, there's no crime as long as you maintain your risk and money management. But understand the concept of hedging, that okay, the market is going against you. Instead of you closing that losing trade, then you can open a reverse trade, a reverse order, in order to overwrite whatever drawdown or negative that you have in that particular negative trade. So I hope this makes sense to you. If you have any question, there's going to be a comment section below this video. Do me a favor, leave your comment, like this video, subscribe to this YouTube channel. By you subscribing, it will help us with YouTube algorithm. Okay, this is a free video where we created out of my busy schedule for you. Okay, thank you so much, my friend, and of course I look forward to see you in our next video. And in case you are watching this and you are wondering, okay, how can you get started trading forex, or maybe you have been trading forex with no reasonable or legitimate or any pronounced result, and you need a mentor. Well, I volunteer myself. I can coach you, I can mentor you. All you have to do is visit www.theforexapostlementoring.com. Put in your email address, get the detailed information about what we offer. And right now we are running a promo, and I hope you will just opt in. And come on, let's make this crazy money together. I look forward to helping you with Forex.